How's everybody doing? Welcome. I'm so glad you guys made the time to come join us after a week like this one. As I say, may we pray for interesting times or something like that. I know on the way out here I was praying that I would have something helpful and intelligent to say today. And really that's the main reason we do these events is our whole goal when we do these is to be helpful. We don't have all the answers, but one thing we do have, we're pretty nerdy. We got a lot of data, so we're tonight's program is going to be pretty data heavy because we're going to go over a couple of areas that we've made some changes in some of the portfolios, which is always driven by a lot of academic research. So this is going to be kind of back to school. We're going to give a real high level of what we've done and why we have done it and what the research is behind it. But we're also obviously going to go over a little bit about what's been happening in the markets. I mean, how many people are nervous in the room after this week? Did anyone get nervous this week?
I brought you more.
Come on, there's more than that.
So with all of this academics and the data and stuff, I wanted to make sure that the program was set up and you knew that it was for sophisticated investors. I see some weird faces in here. So at Align, we define a sophisticated investor as somebody who has lost money at least once investing and didn't enjoy the experience. So now can I see a show of hands of this? Okay, all right, so that's, okay. Just a little bit of housekeeping. So first of all, I want to thank Debbie Stanley. I don't know if she's in the room or not, but Debbie did all of this, and the whole team at Align is just incredible. So I really appreciate all the work that she did to put this together.
Hey, Debbie.
Yay, Debbie! Oh, and importantly, everybody, there is a complete copy of these really juicy legal disclosures. If you'll pick one up and make sure you read those when you get home tonight. I know that's probably the main thing you came for. But Dennis, you want to kind of kick us off with what's going on at Align and maybe the agenda?
Yeah, so just a quick update on the team. We currently serve 176 families. We have $280 million in assets under management. And believe it or not, we've been in business 25 years now. I swear it seems like we just set up here today, it said 15. So yeah. Time flies when you're having fun. But we appreciate everyone here. 25 years is quite a long time. We appreciate you trusting our team with your hard-earned money. So today's agenda, we'll give you a brief market review on what happened in 2017, and then we'll go over what actually happened in our portfolios through 2017, what the returns were. Then we're going to go over some recent academic research that showed us a way to refine our portfolios a little bit and provide all of us a higher expected return going forward. And then we're going to go over how we're implementing that in the portfolios. You've probably seen some trades go through your portfolios the past few months, and this will explain why. And then the final thing we'll do is we'll just go over a few topics to cover some questions we've been getting, some pretty common questions, and then answer any questions you guys have.
Yeah, and if you, I know most of you have read our investment philosophy brochure, but Debbie has a copy. In all seriousness, whether you take the legal disclosures with you that I mentioned before or not, this book really is our playbook. It's really what we do. It's nice and pretty and colorful and all that, but it's our game plan. Dennis is going to go over, what the portfolios did, rate of return-wise and stuff. But that's just a scoreboard. Everything that we'll talk about today, pretty much everything we'll talk about today is in that investment philosophy brochure. So please be sure to take at least one of them with you when you go home tonight. It'd probably serve as a pretty good refresher. I mean, I think it really explains what we do in plain English, and half of it's pictures anyway. So I think it might be pretty instructive for you guys.
It's not a pop-up though. Nope, sorry.
So I had to slip this slide in here at the last minute. That came in about 10 minutes before tonight. And I think it was, I don't know about you guys, but this week, and I know a lot of you guys were, but Jason Duffner, I'm not much of a golfer, but I don't like stress because stress stresses me out. It's stressful. I mean, this week was kind of a doozy, so I thought, that might just sort of set the stage for it. I mean, we're going to talk about a lot of market history and how often these kinds of declines, can be. We sort of forgot I've talked to a number of clients, and then you guys are just, we have the most awesome clients. I mean, most everybody in here has come up and said, hey, how are you doing? I'm like, well, isn't that what I'm supposed to ask you? How are you doing? You know, Harl Dubin, you walked in the room. Well, how are you doing? I'm like, we've been through about 25 of these, I think, since we started working together, Harl, and it's like I don't ever get used to it. But okay, so getting into sort of the meat of the presentation, if we were to go back to the beginning, the end of 2016 and the beginning of 17, there were all these headlines, some of them trying to appeal to our fear emotion. You know, the markets are at a record high, and we're going to take a hard look at some data that we have on what that means, whether it's relevant or not that the markets are at a record high. We all know the whole thing about the guy in North Korea threatening to blow up the world. You know, this bubble, the market's so high, it's doomed to bust. You better get out right now and sell everything. But then on the other side, we had some pretty crazy investment themes over the past year. Hey, put everything into marijuana stocks and Bitcoin, and you can get really rich and, you know, retire early. And I don't really know the first thing about Bitcoin. If you ask, I'll do my best, but it seems that my son and people even younger seem to know everything there is about it. Seems like it's been a pretty wild ride. And then this week, you know, the headline on Monday was the Dow Jones Industrial Average, which is 30 companies. Everybody in this room owns some 10 to 12,000 stocks and bonds of companies around the world. But this measure, the Dow went down, you know, they screamed it was the biggest drop in the history of the Dow, 1,175 points. What they failed to mention was that 1,100 on a Dow of 25,000 is like 4.5%. And look, I don't want to, you know, I don't want to pretend to ignore the elephant in the room. We all hate to lose money. And we're invested in the exact same portfolio as every client in this room. I mean, my portfolio is 80 stocks and 20 bonds, but it's in the exact same investments that you own. So you can imagine this week, well, look, I'll just admit it. I didn't look at my portfolio this week. I mean, you know, I mean, it's just made me sick. I mean, what's the point of that? I know exactly what it did, you know, so. So in any event, I think it's pretty important to maybe put this into context, and maybe we forgot that sometimes, you know, stocks go down. But the fact is, I mean, this is a real, and we're constantly learning around our shop, and you know, so learning and relearning and revisiting. We're going to talk a lot about how, you know, how common this is, and should you be uptight and all that kind of stuff. We all have probably experienced some of this. I know I have, where, you know, I can remember back when I was a baby lawyer in my first career, my second career actually, but, you know, I can remember buying into a company that just went public, and I could buy into it at like $10 a share, and attorney down the hall that Kim actually knows, you know, told me about this company. I'm like, well, sure, I'll buy in. I didn't know anything about investing then, so I'll buy into it. And I bought into it like $10 a share, and you know, I waited a while. I didn't do it right at first. You know, I kind of watched what it was doing, but I watched it go from 6 to 7 to 8 to 9 to, and then when I pulled the trigger, I did that not based on any academic research or any kind of research. I just was like, well, God, maybe he's right. So I bought. And I bought based on an emotion. It's a very dangerous thing to do if you make money decisions based on emotion. And so then that happened, and then, you know, what happened after that? Anybody guess the story? Anyone done this besides me? So then it might have gone up to like 11.5 or something like that, but then, you know, inevitably it started to, you know, go back down. And by the way, I actually had met the CEO of this company, and he was a really cool, great guy, and so I felt like I had some inside scoop on the company and all this, but, you know, it kept going down and going down, and then I was like, well, oh God, what am I going to tell my wife about this? And we didn't have any money at that time, and it was just like, you know, and so then I panicked out, like $4 a share. And then, of course, what happened was, then it starts to go back up again, and, you know, so we all probably have been familiar with that kind of a, you know, experience, and it's just something. But it's, you know, the media feeds onto this, though. You know, this week it was all about they're going down, they're not coming back up, and there wasn't very much wisdom, I don't think. I think there was a little bit of recklessness going around. Every once in a while you'd have a good, well-balanced article, but a lot of it was like, you know, 1,100 points. and not mentioning it's only 4%, and certainly not mentioning that that tends to happen about 2 to 4 times a year if you look back at all known market history. So one of our points today, I think, needs to be, let's be cool and let's keep our heads, and everyone else can lose their minds, but it's best to be cool, especially us. That's our job, is to, when we come into work and manage portfolios and do trading, you don't want us to be emotional, and we try our very best not to be. So anyway, I just kind of wanted to set the stage with that.
Okay, I know there's a lot of numbers on this. I'm going to simplify it quite a bit, so you don't need to be able to read all the numbers. What this shows is mutual fund inflows and outflows every year. What investors are doing, are they putting money in the stock market? Are they taking money out of the stock market? So I thought this is pretty interesting, because this shows you, unfortunately, what most investors are doing is exactly what Brian just talked about. They're investing emotionally. It doesn't make sense. So this top chart up here, you'll notice this line that goes up and down there. That's the S&P 500 since 1999. What happens is, well, let me go over this first. Notice every time we hit a bottom, there's money coming out. Right at the bottom, at the worst time. So you'll see the money's coming in, and it drops. Right there. And so this number, if you look at the actual data in this green right here, what it shows is that's the 8 years before 2008. And it just shows that U.S. investors were just pouring money into stock markets. They're putting, this isn't by the billions, 121, 89, 55, just pouring money in. And then here remembers 2008, right? 2008 happens, and we get, what is that? That right there. So then what happens is, we look at the next 8 years, investors put 1/3 the amount the next 8 years they did the 8 years before. They just quit putting money in the stock market. Even though this is happening, look at this, it went from all the way up here. We saw one of the greatest bull markets we've ever seen, and then 4 of the 8 years, investors are taking money out of the stock market. So then you kind of think, okay, where was the money going? And you might not be able to see it, but underneath the third line shows bonds. The exact opposite. The 8 years after 2008, investors put 3 times as much money in bonds as they did the 8 years before 2008. And so think about this. After 2008, we saw this great stock market, great returns. They're taking money out of that and putting it all in bonds when we're at, what, historic low interest rates. The worst time to go into bonds. They're doing the exact opposite. They're compounding the mistake. So see, it's just all emotional.
Yeah, so this chart really just shows what happened during 2017, and I'm probably going to make this point a couple times because I think it is worth repeating. 2017. So, I mean, I've been doing this now 25 years. It makes me feel kind of old to say that, but last year, it makes me a little bit guilty to admit this, but last year was like one of the very easiest years that I've seen. Working in the trenches doing this for a quarter of a century. I mean, it's hardly ever, this smooth, straight up, and synchronized around the world. It was like you could do no wrong. I mean, it was every day when the market, the bell rang, I guess it's time to make money. And it's just, there were no, So in any event, here's what happened with the markets that we invest in, and then what happened in the biggest holdings that we have in your portfolios. U.S. stock market did 21%, 21.13, and our largest position there, 21.73, so right in line. International developed stocks did 24, and we did 28. Doesn't happen very often, pretty nice. Emerging markets were up a whopping 37%, and our position there right in line, about 36.5 net of fees. Thank you so much for all of your trust and your confidence and your patience, because I know it must have gotten old, Bob, listening to us saying, hang in there with these emerging markets and these international stocks. Well, they finally reverted back to the mean and had a very nice year last year. Global REITs did 7.4. Our large position there did 9.2. I don't want to take away from 2017, but REITs are having a really tough start this year. And then the bond market did 3.5, and we came in at just shy of 3.4. So overall, it was really a pretty solid year across the board. Again, investing is rarely this easy. It's rarely this smooth. It's usually pretty difficult. This week was a tutorial about how, choppy markets can be. So, and I think this chart, have you noticed that between Dennis and I'm always the bad cop and he's the good cop? I always got the, but this chart is pretty instructive about how choppy and how difficult and how often declines tend to occur. So what this does, it goes back to 1980. It covers 38 years of market data. And down here at the bottom, what you'll notice is all these red dots down here, those are the average intra-year declines that have happened in the U.S. stock market represented by the S&P 500 over this 38-year period of time. And so what it shows is they're pretty dramatic drops. Right here in 1980, negative 17. Year I graduated from high school, right here, negative 18. Here's a negative 34. But look what happened. Even some of these dramatic drops. Now this is back in the tech crash right here, and then this was the 2008 thing. But in spite of all these major declines, which made people, I'm sure, very, very nervous, and a lot of these were significantly larger than what we've seen so far. In fact, let me point out, the average intra-year decline on the U.S. stock market, the average intra-year decline on average annually for the past 38 years has been just shy of 14%. So this week we saw a decline of about 10%.
On average, yeah.
That's normal. In fact, we're not, we got another, it can get much worse from here. And if it gets much worse from here, that will still be normal. Okay? But in spite of all that, in these 38 years, 29 of those years, after the decline, they turned out to be positive. So 29 out of 38, if you do the math, that's 75% of the time. So you guys have heard me and Dennis and all of us talk about, and Laura, here's the way markets work. They go up 75% of the time. Flip side is, don't kill the messenger, they go down 25% of the time. And sometimes pretty dramatically. So watching your portfolio every day, especially if you're watching your portfolio and listening to the guys on CNBC, it'll give you a heartburn. So take the long view, I guess is.
That's for sure. Yeah, so the fact that we expect declines and we plan ahead for them is the whole reason we have bonds in your portfolios in the first place. That's why they're there. This is a good example. This was the returns of our 5 largest bond positions this last Monday when all the markets declined over 4%. You'll notice all of them have a positive return. And so this goes back to you, especially for those of you who were doing, we're sending income as we go. This goes back to, we talked about having 3 different buckets of money. We want to have 1 year of your income in cash, and then maybe the next 2 to 4 years we'll have in these top 2, real short-term, high-quality bonds. Because when we see market declines, we see what happens. They really don't go anywhere. They might go up a little bit. And then we have the second bucket, which is your, maybe the next 4 to 7 years of your income need, and some longer-term, higher return bonds. And you see those did a little bit better. All right, they were a little more volatile, but they also went up in a down market as well. So what we've done there, for most of you, we have at least 7 to 10 years of your income need outside of the stock market. Okay, we've bought you time, which is the most important thing. We're not forced to go sell stocks when we go through something like this last week. We prepared for it. So a globally allocated stock portfolio like ours, the way yours is, there's never been a 10-year period where they're down. And so if we have 10 years of your income need in bonds, worst case scenario, we can go through those bonds. We don't, no one likes seeing the declines. It's not fun to go through, but we've planned ahead for it. We know it's coming. And so you don't need to, what about can I still get my income check from you next month? That's why they're there. So it kind of, we were complaining about the weather. It was nice today, but it kind of made me think about the weather. We don't know where, especially in Oklahoma, we don't know where it's going. Last year was kind of like Los Angeles weather. It was nice every day. No one complained. It was great. But the stock market's usually like our weather. Who knows where 60 today? What do you think it'll be a month from now? Who knows?
Snowy.
So let's say it's 20, but what does everyone in here have? What if it is 20? What did everyone in here buy? We all have a coat. we planned ahead for it. So bonds are kind of like our coat. We just put the coat on, we complain about it, but we know it's going to get nicer in the future. So that's why they're there.
Okay, back to bad cop now. So we're going to go back even further into this history of declines. And so what I did is I went back and I found this little piece of data, and it's what happened in the U.S. stock market going back to 1900. So now we got 116 years worth of declines, and I just wanted to kind of look at some deeper data. And what we see is these declines, like we saw this Monday, those happen on average about every 4 months, based on 116-year of capital market data. And we ended up, I guess, this week not quite down 10%, but yesterday they were all talking about how we're in correction territory officially or whatever at negative 10%. And that tends to happen about once a year, and it always goes on longer than we want it to, 115 days. I mean, this started on Monday, and by Thursday I was a little bit worn out about it, and I know you guys were even more worn out about it probably, but it tends to last about 115 days. But then the story gets even worse, doesn't it? Because look down here, a bear market defined as a decline of 20% or more in the markets tends to happen about every 4 years. And it tends to go on for, on average, a year. Since World War II, these bear markets have stayed down about 18 months. And so this is why what Dennis talked about, how we want all clients to have in their short-term bucket, cash and money markets of at least 18 months to 2 years. And then we might have a medium bucket that goes from 3 years to 7 years, and then another bucket that goes from 8 to 10 years. And so we know where you're going to, and hopefully, and if you don't, get in and put us to work, where your income is going to be coming from. I can't tell you guys, we may be right in the middle of a bear market. I don't have any shame in saying that, because I don't think anyone else knows that either. And I think if you listen to the really greats in the investment business, like Buffett, he'll tell you the same thing. Yeah. He doesn't know where the market's going short term, neither does anyone else. I know the guys on CNBC will sit here and say, I'm call the top and call. They don't know. I mean, they really don't. In case you don't know it, these guests on CNBC, most of them are they pay to get on there. It's like paid advertising. So, when you listen to anyone on some of the on the media, take it with a grain of salt. I mean, I really, why is this person preaching this story? And there's usually a reason. There's usually a reason behind that. So if you look at this, though, I mean, you're probably sitting there going, well, that sounds really negative. Why would any breathing human being put themselves in a position to lose money at the rate of 14% once a year, and what, 20% or more about every 4 years? Why would anyone do that? And so this next picture, I hope,
there you go, you got a positive one.
I hope this tells the story. What it shows is that in spite of all those horrific declines, if you just put $1 in the S&P 500, the U.S. stock market back in 1970, it grew to be worth $100. Now, I don't know about you guys, but in my world, 100 times something is something. I mean, could you imagine if you had like Stephen Glee 100 more times, grandkids than you have? Or Claude 100 more times money than you have? Or 100 more, 100 times something is something. And that was in spite of all these horrific declines. Now, if instead you said, I saw that chart before, it was very negative. Negative 14% once a year, negative 20% or more every 4 years. I'm not going to do that. I can't take that. That's too risky. We stayed in nice, safe T-bills or CDs. We ended up with $9.20. Far cry from 100. And then if you put it into a globally diversified portfolio, like the portfolios that we run for you guys, you ended up with not 100, but 400. So hopefully that sort of gives us a notion of, and I know you guys probably know this, but I'm just trying to give some perspective about what's going on, why we're engaging the risk, and what the payoff is for doing that. So this chart, I think, shows that the long-term, disciplined, unemotional, if you can be, investor tends to get paid pretty handsomely for those temporary, very painful episodes. And again, I think I said it before, but one of the best things you can do during this period of time is just turn off the TV. Yeah. Just turn it off. I was watching a Warren Buffett last night, and it was actually from 2016. But that was his message. He's like, If you own great businesses, which everybody in this room, you own some of the 10,000 of the best businesses on the planet in your portfolios. Why do you want to get a quote on that? I mean, it's kind of like, do you want to get a quote on your house every day? Are you planning on selling the house? Then why do you care what it, you know? But a lot of people sit there and click, you know, refresh on their computer day, you know, minute by minute by minute. It just drives you, but I would think it would drive you bananas, but you know, what, yeah, so.
Agreed. Okay, back to good news.
Good cop, bad cop.
So this is just a snapshot of how our 100% stock portfolio, I know most of you, the large majority, are not in 100% stock. So this is actually what my money is in. So I have not looked at mine this week either. But what you'll notice is, just to compare apples to apples, our 100% stock portfolio did 22.6% return in 2017. So I'll take that anytime. And we slightly outperformed the S&P 500 by about 1%. And really that was due to, for the first time in 4 years, we saw international stocks outperform US stocks. And so that gave us a slight outperformance over the S&P 500. But what really matters is, if you look over, I know you can't see this, so I'll tell you what it is. On the right side, we go through at the end of each year and we figure out, okay, what's been the annual return since 1999? What's the average annual return? And so our stock portfolio has done 8.4%, the S&P's done 6.1%. So we've been able to outperform the S&P 500 by a little over 2% every year on average. Now, 2% may not sound like a lot. We get really excited about it because we know what 1 or 2% can do. We're going to go over some refinements of our portfolios that are expected. These little positions will give us another 1 or 2% expected additional return over time, and it just really adds up. So this is a great example. Just from 99 to 2017, if averaging about that 2% more a year, instead of $3 million, you have $4.7 million. So almost a 60% more money at the end of the day. It's a lot of money.
Hey Dennis, I know that there's got to be at least one client in the room that's wondering, what about fees?
That is all net of fees. So that's net of our fee, net of fund costs. And the way we figure these is, I'll go over some of our other portfolios. This is a composite of all the clients in that portfolio. So this is a composite of all the clients in that 100% stock portfolio. Net, again, net of our fees, net of fund costs. This is what you actually saw. Thank you. So again, these are 4 of our more popular portfolios. Most of you are probably about right here, and this balance about 60%, you're 60 to 70%. In 2017, our 60-40 mix did 15% in 2017. If you're a little more aggressive at 75%, you're at 18%. And even the more conservative, you're 40%, you still have more than a 10% return. So again, 2017 was great. I wish all of them were like that. And importantly, to kind of go back to the annual return, if we just looked at the 60-40 mix, again, the S&P 500 did 6.1 per year since 1999 on average. Our 60-40 mix, so with 40% less stock risk, okay, you don't have 100% stocks, you only have 60, we still outperformed it by 0.2%. So you got a little better return than the S&P 500 with 40% less risk over time. And if you stuck with it, I mean, you look at like the tech bubble bust here, here's 2008. If you started in 1999 with $1 million, you didn't freak out at any one of those points and try to time the market or anything, you stuck with the plan. At the end of 2017, you had more than $3 million in a 60-40 mix. If you stuck with it.
Hey, Dennis, will you go back to that for a second, Dennis? I don't know if I voiced this, and I know I have many times, but one of our mantras around our shop has always been, listen, let's manage this money for this client for all clients. Let's manage the money with an eye towards the downside. The upside will take care of itself. Almost we're kind of hardwired like this, that losing money is like twice as painful for most people than the pleasure of making a profit. I don't know if that rings true to you guys, but for many people, the pain of a loss is a lot worse than the pleasure of a gain. And so I just wanted to kind of maybe go in here and look at some of these numbers and see if that really is held true based on the numbers that we put on the board. So I don't know how many people were, getting, kind of carried away with all the, it seemed like back in 98 and 99, there was a bunch of, if you came up with a publicly traded company and you came up with a name like, it's going to be a pet store. I remember there was like this petstore.com or something.
Pets.com, yeah.
If you put, .com on the end of any company's name, it didn't matter whether it had any sales or earnings or not. I mean, the stock would just go to like 100 immediately. You all remember those days? It was just absolutely crazy. But if you take a look at what happened, so the wheels came off of that, not surprisingly, over here. I can't see or hear anymore, you guys. Here, I'll probably know that. But you go down here, and here's what happened. So everybody's making all this money in 98 and 99, and then, you look down here, the S&P 500 did -9, international did -12. I'll just stick with U.S. -12, -21, and you go back up and look at even our equity portfolio, up 5, -3, -16, and most of you guys are in about a 50 to 70% stock. So we look at this 60-40 portfolio, and most of our friends and neighbors, now they won't admit this to you because they made like 90% on their Munder Net fund or their Janus fund or whatever. We all owned them. I mean, I know I did too. But in any event, if you kind of take a look at what really happened with these academic oriented portfolios that we run for you guys, up 5, market was down 9, up, what is that?
0.2.
Let's call it flat. Didn't make any money, but compared to -12, it's pretty good. 2002 -7 versus a -22, and then if we beam forward to 08, I mean, we all remember how. And look, I wasn't naive enough to sit here and say, "Hey, Mark, you ought to be happy, man," because your portfolio was only down -18%. I mean, it could have been worse. It's like saying you should be happy I shot you with like a 22 versus a 45 automatic or something. But the point is, it's that paying attention to the downside has really kind of smoothed these returns, and that's really why these numbers over here, maybe look a little bit better than just the index returns over there. And really the kind of the interesting thing about all this is that we didn't put those numbers on the board being some guru stock picker. We didn't put those numbers on the board knowing how to time the markets. It was just applying the academic research, rebalancing, coming into work every day and stoically saying, what are the rebalancing opportunities? And should we be selling something that did better than we thought and buying something that did worse than we thought, and relying on this academic research? And you can kind of take me over to that now. So our whole model is based on really relying on academic research. We don't really use any Wall Street research, and the reason for that is really very simple. If you think about it, and if there's any ex-stockbrokers or stockbrokers in the room, I apologize for this, but I believe in my bones that it's true, that the primary purpose of Wall Street research is to sell Americans stuff, maybe stuff they don't need, and generate big commissions for the firm, right? Well, the primary purpose of academic research is to find the truth. I mean, you got a professor at Chicago or Dartmouth, I mean, they're wanting to win the Nobel Prize, and the only way they do that is to publish a paper that comes closer to the reality of how capital markets work than the last guy that published a paper, right? So we think it's a little bit cleaner and more objective, so on and so forth. And we've been preaching this stuff. I'm not going to get too detailed into the academic research, but we've been talking about, if you go to some of the premiums. Oh, yeah. So at this point, so the academic, really the whole area of financial science, if you will, and Nobel Prizes being awarded for financial academic research really started about in the 1950s, and then along about in the late 70s and early 80s, with the power of computers, these academics were able to really kind of churn and look at big data sets. And so we've been using it for a long time, and we've been talking about the small cap effect and the value effect and all this boring stuff. I know you guys don't want to hear a lot about that, but the point that I'm trying to make is, at this point, we're just refining these portfolios. I mean, Dennis went over the numbers, and I like to think that they look pretty good. It's your money, and you can decide for yourself, but I like to think that our performance is pretty strong. So at this point, it's really just, it's refining portfolios that are already extremely diversified, and we think produce real results in the real world for real people. But if we go and take a look at some of the, so we've talked, like I said, we talked about how small company stocks have outpaced large company stocks over long periods of time, and the data is very robust, and we've been tilting towards small companies for a long period of time. Most people in the room are clients, and you know this to be true. And we've been tilting towards value companies more heavily than growth companies for a long period of time, and probably everyone in the room knows that this is the way Mr. Buffett made all of his money, being kind of the king of value investing. There was a recent paper that was written by a guy named Marks out of the University of Rochester at New York. It has no connection with the Chicago School, which you guys know we follow that very closely. It's got no connection with Dimensional. So it was a totally unrelated academic that came out with this notion of, well, what about looking at profitable companies, and do they really produce higher returns than unprofitable companies? So, well, that makes sense, but is it true? Because most of the times, if you look at a glamour company, somebody that's, a company that's really growing real fast, you've got to pay too much for their premiums. And if you overpay for anything, it turns out to not be a very good investment. Does that make sense to you guys so far? Kind of common sense? So, and the more that other academics, the cool thing about the academic research is that they're pretty open about it. I mean, they publish the paper, and then all these other academics will go in and kind of slice and dice it and say, well, does the Marks guy from the University of Rochester really have a handle on this? Is he really accurate? Did he really do the research right? And the more that the academics, so it's been reviewed by Fama at Chicago and French at Dartmouth, and the more they slice and dice the data, the stronger this profitability premium is appearing to be. So we're tilting more towards the profitability premium, and that's why we've started to make some of these trades out of our plain vanilla large cap US and international stock funds and into, and if you can kind of give me some of the numbers up here, Dennis, on the, so I don't want to bore you with all these numbers, but the profitability premium, what we're looking for on these premiums we're looking for a dimension of return that we can capture that is robust. Now, I don't know about you guys, but 4% annualized is pretty robust. I mean, we can't promise that's what it'll always be in the future, but that's a pretty big bump on return. And it's persistent. And so what we have down here, these are the rolling 5 years of where the profitability premium turned out to be a positive return to the client portfolio. So it's robust, it's very persistent. And here's really the cool thing about the profitability premium is it's more of a growth strategy, which is a very nice complement to all this value strategy stuff that we've been using in your portfolio for years. So it actually, well, the data is it'll increase your return a little bit without any increased risk measured by standard deviation or the up and down movement of the portfolio. So we're pretty excited about it, and and I know when I talk about it, I knew that this was going to be very academic, but these are the kind of companies, Dennis, if you go to so this is what we're talking about. We are enhancing portfolios by increasing our investments in these kind of companies. You guys, probably recognize most of these companies up here: Amazon, Microsoft. For the guys in the room, we have Home Depot. For the ladies in the room, we got Champagne and Louis Vuitton purses. So these are, these are great big, a lot of them very old, very established, great brands, and really very profitable firms. And again, we already own these companies. We're just buying more shares in them. So any questions about that? Does that all kind of make common sense to everybody in the room?
Good.
No.
When you say profitability, is that the same as the company paying dividends?
No, not even close. You can have, you can have a hugely profitable company, and the one that comes to my mind right away, Apple, that is hugely profitable is Berkshire Hathaway. It's run by Buffett. Everyone in the room probably knows. If you don't know, it is a highly profitable money-making machine. It does not pay a dividend and never has. Okay, so, and in fact, and I don't want to go off the beat here, but we're not, in this, we're not talking about earnings either, because earnings can be gained, right? I mean, all these big companies can hire the very smartest, fanciest, tax lawyers and CFOs and accountants in the world and take one-time write-offs and make the earnings look any way they want. Okay, so what we're really talking about here is very, very basic. Sales minus cost of goods sold is gross profitability, something that really can't be gained too much absent fraud, and I don't know what to do about it. So gross profitability, you look at the current gross profitability, it tends to indicate that that company is going to continue to put numbers on the board. So again, just an enhancement, but anytime, I mean, we go to work every day, we're looking for a way that we can squeeze another, 0.25% or 0.1% or, maybe 0.5%. And if we can deliver that into your portfolio, it all adds up. So, Dennis, you want to talk a little bit about what we've been doing on the bond side?
Yeah, some exciting part now, bonds. All right. They're exciting, right? If you don't know, this is what I did the first year out of college. I was a bond analyst. They're not exciting. All right? I did it for 1 year. So here's the deal with bonds is, remember, before I get into this, remember just a bond, you're loaning your money to a company or a government. Instead of owning shares, that you're just loaning them the money. And so there's really two factors that decide your return you get on a bond. The first one you see here is what's called the term premium, just how long are you loaning them the money? And think about when you went and bought a house. If you got a mortgage and you did a 15-year mortgage, you paid a lower interest rate than if you did a 30-year mortgage. Same thing on bonds. The next one's called the credit premium. Same thing, if you leave here today and think, okay, it's better than, we're fine, let's go get a car. So you go into the car dealership and you have a great credit rating, you might get 0 or 1 or 2% interest on a loan. But if you have a lower credit rating, they're going to charge you like 9 or 10 because they're taking more risk. So that's really the two things that decide the return you get on bonds. So you probably noticed that we've been getting out of what's called the DFA investment grade fund into this DFA Global Plus fixed income fund. It's very similar. You're going to own a lot of the same things as what you had before. But really the difference is we're giving, this fund manager has a little added flexibility to take advantage of what's called spreads in the bond market with these factors. And so there's really a few things that help it. First, it's just more diversified. It's kind of like the stock portfolio. We're going to own different types of bonds and a higher number of them. We're going to spread out that risk, just like we've done in the stocks. The next one's the maturity. So they're kind of limited before to 5 to 6, 7 years. Well, now they can look at the spreads of it. So if there's a 5-year bond and he's going out to buy it, he can get 3% interest on that. And he looks at a 10-year bond and it's paying 3.25. There's no reason to do that. Just go buy the 5-year bond. But that spread will change, and it changes often in the bond markets. When there's what's called the yield curve, it'll change. So if you, again, you look at a 5-year and it's paying 3%, and a 10-year is paying 6%, he can go get that 10-year now and get you some additional return. The same thing on the credit. So you can look at, if you look at a AAA, the best credit quality, there's not many left, but Johnson & Johnson's one of them. So same thing, if it's 3 and maybe a few notches lower is GE at single A, if it's 3.25, that's not worth taking the risk. Take the higher quality one. But if that spread changes and now that GE is paying 5 and it's still a good investment grade bond, well, that's worth taking the risk for. So now he can go a little bit lower and get that little lower investment grade and get that additional return for you. And then finally, he can get out of the US. So he or she, the bond team, the fund management team, they can look outside the US. A good example is Germany has a higher credit rating than the United States. And so he can diversify out, there he can go look at, okay, Germany's got a better credit rating, we'll stick with 3. If they have 3 or 3.25, same or better, let's diversify and go get some German bonds. So we're adding that diversification. And so by doing this, you'll see the expected return is about 2% more per year. And that's really due to the yield, which is really the only way. If you'll notice our bond funds, you don't make money in the price of the fund. It's going to be pretty flat. You're not going to see a lot of gains in it. Here's where all the gains coming from is the yield, the return. And so the return of the previous one was about 2.5%. This Global Plus is going to be expected to be about 5.5%. So quite a bit more yield. Then what we're doing is why you might not see a lot of return in the if you just looked at the capital gain of the bond fund itself, is we're taking this income, and it's kind of different for everyone what we're doing. If you're taking income out of your portfolio, we're sending you money each month or whatever, we're going to use this to replenish your cash. So that's going to go right back in your cash, or maybe right back in your short-term bonds. If you've got plenty of cash, or you've got plenty of bonds, or you're not taking income, times like this, we're going to take that and go buy stocks when they're down. So we're going to use that as part of our rebalancing. So we're not just sticking it right back in the bond fund every single time.
May I just add something to that? So I know that I've gotten a few questions about what's happened with the bond fund and why have I not made any money in the bond fund. So everyone, I don't want to repeat what Dennis just said, but our strategy in order to save on trading costs and income taxes is we do not reinvest dividends and capital gains. We let them go to cash and then we use those to rebalance the portfolio, okay? So for the and to kind of highlight that, for the past 45 years we saw interest rates. I can remember my parents arguing about the rate of the mortgage when I was in high school. Sorry to throw you under the bridge, Dad, wherever you are, but it was like 18% or something. Remember that in like 1988? And so that's where CD rates were as well. How many people in the room remember that when you go down to the bank and get like a 16% CD? But what's happened is they've gone down and down and down and down, and so over that period of time, we could make big capital gains in bonds, rates going down, and the value of your existing bonds, might go up. But if we're going into and I don't, look, everyone's been talking about rising rates for a long time. Maybe we're going to start this year. I'm not going to weigh in on that. I've been wrong. But the point that I'm trying to make is I think that the days of making capital gains in bonds perhaps have come to an end. So all we're getting are we're getting these interest payments, and so if you just look at what the price you paid for the bond and you understand that the interest or the dividends are going to rebalance the rest of your portfolio, maybe it'll help you to, and feel free to call us anytime, but I don't think that you can expect to see capital gains just based on what we paid for a bond or a bond fund and what it's worth today, because we're using the interest payments either to send it out to you so you can use it and go to Florida and have fun, Jimmy, or whatever you want, or we're using it to rebalance the portfolio.
So this again, just to kind of give you
In the back? Yep.
I have a question for you back.
Shoot.
Why is it that some of the stock people talk about it's really bad if your yield is going up if you've got bonds? Why is that bad? I always thought the yield going up was nice.
Well,
that,
one of the only good things about falling security prices anywhere is that, as the price of anything goes down, the yield goes up. I don't know if it's necessarily a bad thing, but I would say that if you go and chase yield, that
doesn't work out.
That's a strategy that typically ends pretty ugly. I mean, nobody, if you go down to the car lot and, buy a new car, who's paying 10% interest today? People with good credit or bad credit? So if someone's paying 10% in yield, there's risk there. You may not see it, but it's there. Mm-hmm. I don't know really what stock people you're talking about or anything like that, but high yield, you need to understand high yield. Look, here's all I'll say about that. There are no high yielding, low risk investments. Let me repeat that. There are no high yielding, low risk investments.
None?
None. I mean, the prime rate's at what, 3.5 today? The 1 month T-bill is, Darlene, do you know, is paying what? It's just a little bit higher than zero. So there's risk. Risk isn't necessarily bad, but if you're going to engage risk, I want to know how it typically plays out. And the way we do that is we look at decades and decades of academic research to see how does that risk. If we're going to go in and we're going to take Jimmy's money and tilt it towards a risk factor, I don't want to be having excuses for this didn't work out the way I didn't think because I didn't do some research on it. So if you're going to be taking risk, I think it's real important to know how ugly it could get, how good it could get, and everything in between, just so you know how things are likely to play out. That's all I'm saying. So I don't know if that answers the question, but.
Get it? Okay, to finish up on these exciting bonds, this just gives you a snapshot of a few of the bonds that you own in this fund. You'll notice you're loaning the corporate bonds up top here. You're loaning your money to Walmart and Exxon and Apple and things like that. All right, and you've got a few of the government bonds down here. So, you see we're getting the 700s on the corporate bonds here. But I wanted to take this opportunity to kind of show you the reason we like this flexibility. If I'm going to take these two up top right here on the corporate and blow them up, this will give you an idea of what I'm talking about. So you'll notice on this bottom one, it matures in 2024, so we're loaning up for 6 more years, and we got 2.625. That's how much income you are getting from it. That's your interest payment. So by giving it a little flexibility, the spreads widen on longer bonds. Got this 2030, so you're loaning your money for 6 more years than you did on the previous one. But now you're getting 6.625 every year is your income payments on that. So that's a risk we're taking. If we're sitting here and it's 2.6 and 3, we might be asking why they did that. But this is, you get 4% more every year. And so that flexibility is going to add that additional income to you.
Okay, there's been a lot of talk, wouldn't you say, about the market being at an all-time high. Everybody agree? And, maybe a little too much talk based on what we see in the data. So if you look over here, this is a data set. So what's the significance of the market being at an all-time high? Does that mean that, well, we're headed for a fall and we ought to sell out? I think that's the implication, right? So what this data set, so it goes back to 1926. It's a very long, very varied, and therefore perhaps pretty meaningful amount of data. And what it shows is over here on the right, and this is consistent with everything we talked about today. It should not be surprising. What it says is that from any market level, whether it's a market high or a market low or everything in between, okay, are you with me? Here's what happens over the next 12 months. 75% of the time, the next 12 months result in a positive return. So that's not surprising based on what we talked about, right? Everybody, that's consistent? Now here's what may be surprising. At least based on all the media hoopla about the market's at a high, the market's at a high. And I can't tell you how many people have come into our office, especially new clients. Well, should I put the money in? The market's at a high. Well, let's just look at the data. Here's what was really surprising to me is, so over here, the market from any level goes up 75% of the time. But over here, from an all-time high, it tends to go up 80% of the time.
Who would guess that?
That's impressive.
That's that one. The story that we've been told, look, let's forget about investing. Who in the room is scared of heights like me? Anyone? Yeah. The media knows this to be true. So it's a story that is believable and it's scary. Aren't you scared to fall off it's scary. So we have bought into this story that the media has told us, but the data says the only problem with the story is what?
It's not true.
It's simply untrue. It sells a lot of ads, but does it give us any actionable evidence to do anything different? Should we just go to cash because the market's at an all-time high? I don't think it really, what's the significance of the market being at an all-time high based on the data? I would say it's not much. The markets go up 75 to 85, 75 to 80% of the time, whether they're at a market high, a market low, in between, everything in between. So, again, maybe check your sources before you go getting worked up about, well, the market's at a high, better watch out. Maybe true, maybe not.
Okay, this is my favorite chart to show someone when they ask, well, should we get out of the market right before it goes down and then get back in when it's done? And so my answer is, if you know that's going to happen, definitely do it.
Sounds good, doesn't it?
I would definitely do that. But the problem is what? You never know, right? So this shows you how dangerous it is to try it. This starts it says if you put $1,000 in 1990 and invested in the S&P 500, didn't pay attention, didn't open your statements, just left it alone. The end of 2017, you open it up, you have $13,739. Not too bad. But if you opened one of those statements and you thought, it's going to go down, and you missed the one best day in 37 years, this is over 9,300 trading days. All right, you missed the one best day, you lost $1,400 of your return. 10% of it's gone. Okay, then you move over to, let's look at the, look at the best 15 days. Remember, this is 15 out of more than 9,300 trading days. You go from 13,700 to 5,300. That's more than half your returns gone trying to time the market, and you miss 15 days. And then if you look at 25 days, you barely beat the CD rate. Just stick your money in the bank. Be done with it. Quit worrying about it. I mean, it's pretty amazing. So that just shows you how dangerous it gets. And here's the deal, too. I mean, that 1 best day and the 5 best days and the 15 best days, and when did they happen? They happen when you least expect it.
Yeah, that's for sure.
When the news is really bad, and we hit a market bottom and it takes off, and you're like, where's that coming from? And then you get back in, you missed it. It's gone.
Okay, so, when markets get rocky like they have been this past week, and again, I'm not, I don't want to minimize the fact that it's painful to watch, all right? But a lot of times people will ask, hey, Brian, or hey, Dennis, what is your bear market strategy? And this is it. It's called rebalancing. This is not only our bear market strategy, this is our bull market strategy, this is our everyday strategy. This is what we do when we come to work every single day as we look, and just like I was talking with Claude today, we go through and say, okay, things have been rocky. I want to see, we'll get with our traders and find out who is out of whack, who is out of balance, and should we be selling something that did better than we thought and buying something that has done poorly. So how does this relate to our bear market strategy? Well, typically, as Dennis went over before, bonds will do a little bit better, at least relatively speaking, compared to stocks, and so we'll sell a little bit of bonds and buy a little bit of stocks. Or sell a little bit of whatever during a bull market. We'll sell a little bit of something that did, a return better than the expected return, and we'll buy something that's now discounted at a lower price. And it's just a continual, and it's something that we do every single day. As Dennis mentioned, I mean, when stocks move, like this week, we saw stocks move to the downside, and it happened, just in a handful of days, right? And same thing on the upside. They tend to move in a handful of days. We never know when those days are going to be. That's why timing the market is so difficult. But that's why it's so important with our rebalancing strategy that we're watching these portfolios every single day to figure out, okay, is this a time when I ought to be looking at Carol's account and getting that back into whack? Is this a time when I ought to be looking at Dwayne's account and getting that back into whack? Because we never really know what the days are going to bring. So this whole notion, I don't want to get way off track in, but we used to, you guys know that I've been doing this so long that I've made all the mistakes. Way back in the beginning, we'd rebalance once a year, and then I read this thing that said we ought to rebalance, like every 45 days. The markets could care less what our little rebalancing strategy is that we came up with. So we watch every day, and when it gets out of whack by more than a specific band, and it tends to be around 10%, but it can go from 2 to maybe 10% on the high side. If it gets out of whack, then we rebalance, or it's a rebalancing candidate. So,
Quick question.
shoot, Kathy.
You listen to the CNBC, Valley and Rouge, Valshi and all that. They're always talking about, like, with the stock market, then they talk about the economy. Does it go hand in hand?
Good question.
Since the stocks tank, does that mean the economies?
I'm so delighted that you asked that question. Because this is another thing that it took me forever.
Repeat the question.
It took me forever to even figure out, and again, it's looking at the academic research, it's not looking at the media.
Let me repeat, someone asked to repeat. She asked, is the stock market tied to the economy? Right? Isn't that what you're at?
Yes.
Okay.
Here's the fact of the matter. I mean, where we are right today, I mean, a lot of people have been talking about, well, why did the market fall apart this week? And, President Trump's been all over the place tweeting and whatever he does about, well, everything's good. Everything is good. Well, I mean, we're earnings reports have been just outstanding. Unemployment is at like record lows. I mean, everything is good. But here's the thing. The fact is, and if you look at all of your investing history, you'll maybe see that this is the truth, is that what the media has been feeding us is not the truth. The economy and the stock market are correlated only over very, very, very long periods of time. Periods of time that it's too hard to measure. So, I mean, if you look at what happened, the economy was, you look at Dennis' chart before, from what happened from March of '09 until at least 13, I mean, the economy was in the tank.
Yeah, and ours was up 32% that year.
And the markets did great. So, yeah, this whole notion of the economy's doing good, so just wait, it's going to show up in your stock prices, it's just completely untrue. There's not a connection except over periods of time longer than you want to wait. I promise you that.
So it's fake news.
Fake news.
I guess, yeah. That's a new term, I guess, but yeah.
That's a good question. Okay, I like doing examples. So to follow up on Brian talking about rebalancing, I just wanted to give an example over the past 3 years. This is a very simplified example. Remember, we're doing this for every single asset class, 12 to 14 different holdings in your portfolio. So this is only 2 of them. But this goes back 3 years to 2015. And then the blue line here is our emerging market core position, what it's done over the past 3 years. And the orange one is our long-term bond fund. And so I wanted to show you, just by paying attention, we're looking at this every day, do we need to rebalance, do we need to rebalance? Here's what happened with these. So you'll see emerging markets is doing pretty well, and then we hit 2015, we saw about a 15% decline there. And so that's the point we said, okay, now we're underallocated emerging markets. The long-term bonds are up a little bit, let's go sell some of that. Go put it back in emerging markets. Let's get it back to where we need to be right here. So short term, that looked pretty good. And then it fell another 15%. And so we looked at, okay, now our bonds have done really well. Those went up. Let's take that gain. Let's go put them back in. Let's go put those gains in emerging markets. And this is when a few of you kind of came in our office and like, what are you guys doing? All right, why are you doing that again? Didn't you learn from the first time? I mean, it went down 15% again. So here's why. Now, we don't know it's going to happen instantly like this, but you see it instantly, we saw a 35% increase in about a year and a half. And so then what do? So we're not celebrating or anything, we're just going, okay, now we're over allocated in emerging markets. We took that nice run, let's take some chips off the table. Let's take that gain, go put it back in the safe bonds, or go put it, if you're taking income, that's when we put it back in your cash flow, and put it back in the money market. So then, about 6 months later, we had another, I think it was 20% decline at that point. Same thing. Took that profit, went and put it back in the back in the bonds that we're underallocated in now. And so if we look at where we started, if we started with $100,000 at that point, and we did nothing, we just left it alone and let it ride, we ended here with a 33% gain. Not too bad. So now you've got $133,000. We'll take that. But by doing these 4 trades, these rebalancing trades, we had $162,000 instead with the same 2 positions. So we added about $30,000 of gain right there just by watching this every single day and looking at opportunities to rebalance.
So you probably already answered this, but why is it when the emerging markets go down and that you keep confidence in it, that you still have confidence that they're going to go back up?
The main reason is because we own almost all, it's not like we're picking out the 10, we like these 10 emerging market stocks, we own almost all of them. And they've never not come back. That could happen if we said we like, I don't know, an emerging market stock. I'm trying to think of one, some China stock. So,
China
what's the Alibaba or whatever, we like that. And we put it all in that could go to 0. That could definitely happen. We're buying, like in this position, owns like 3,630 stocks, I think is what it is. If those all go to 0, then that means probably the US is all 0 and the international is all 0, and we're not going to care about money anymore. So at that point.
Yeah, so we own all the emerging markets. And another thing about, and I don't want to sit up here and beat the chest about emerging markets or anything, but you think about what's going on in some of these emerging markets like Brazil or India. I mean, India, where I don't know if you've seen the movie Slumdog Millionaire, but I mean, all these kids are just getting the flavor of what capitalism is about. I mean, they're just getting maybe a car, and they just now got a cell phone. I mean, so that kind of gets off the beaten path. But what Dennis is saying is we're buying pretty much all the stocks in the emerging markets with these tilts that we talked about, small cap, value, now the profitability. But we're buying thousands of them, so they're not all going to go to zero. I mean, unless we have an asteroid hit the Earth and it's over, and then money doesn't matter anyway, I guess. But
all right.
So we talked about a lot. I mean, this program's been more detailed than probably anyone that we've done. Our process is really, and our job, I think, is really pretty simple. I mean, our job is to sit with you and really understand, Carol, what are you trying to do? Where are you now? What's your point A? Where are you trying to go? And then help you maximize your resources and control the things we can control, which, after doing this a long time, I'm pretty humbled. There are very few things that are within our control, but we can control risk and cost and tax by proper portfolio structuring and smart trading and patient trading and things like that. Beyond that, obviously we can't control the president, we can't control interest rates. I don't know what the Federal Reserve is going to do. Who knows what's going to happen in all those other areas. But Mark Peters.
This is two or three parts. First of all, congratulations on your silver, 25 years. Good job.
Yeah, thank you.
I found it in 2006, and 8 happened. And what really sold me on you guys was the fact that you guys were really down. I thought 17%, you said 8%, and the market was down 50. And to me, that more than exceeded any objective I had with you guys. So I fell in love with you.
Thank you.
But do you see any potential other black swan that was due to a thing out, interest, the real estate markets and all this? You guys, is there any talk of student loans was out there for a while? Is there anything else out there that could affect this market?
I think there always are, in hindsight, there's the people that saw that coming, but it's, no, not really. I mean, studying all known market history, a tsunami event like that seems to happen about once a generation. Hopefully you got yours, you're not going to get another one, but I mean, no.
And my second part of that is, you guys have got this down to a pretty good science. If something happens to you guys or your staff, does the lines, you got to place things in line for a line, do they keep going or what happens?
Okay, so that is a
question.
very, very good question. What happens? Look, I'm not really that important anymore. I mean, the team is what,
That's not true.
But, Dennis and I could both be on a plane going to some educational conference or something like that. And this is one of the key reasons that about, 5.5, 6 years ago, we made an alliance with this firm, Forum Financial Management, out of Chicago. And you guys have heard some of those guys talk. They're a firm just like ours, except they're about 10 times as big. They manage about $3 billion. We manage just about $300 million. And they've got, their philosophies are so similar. They're normal folks. What you see is what you get. Now, they are in Chicago, so I mean, that would be an option, is to keep your account with Forum. Another great thing is I'm 54, Dennis is 43. You'll get there.
I had to think about that.
So it is a very legitimate question, and it's something that we've put some thought into, and there is some succession in it. They would be able to carry on if something happened to both Dennis and I. And, of course, there's Darlene and Laura that have been running our philosophies for a while, and I reckon there'll be another planner join our group sometime. You may have noticed that we really haven't. The goal has never been to, our goal has never been to get really, really big. In fact, there's some people in the room that we were working together when I was in a different partnership, and that partnership sort of fell apart because the other partner wanted to just grow and grow and grow and grow and grow, and I'm like, well, why are we doing all this, And so we're trying to stay small, keep our client base small, do financial planning, and not get really, really big. So it's a tightrope. But we have, I mean, I don't know if that answers your question, but that was one of the main reasons that we align with the guys at Forum. And I'm telling you, pretty much everything that they've done, what's really impressed me about those guys, not only are they really, really, really bright, but they, you know, there were a couple of glitches like there are in any business relationship, and they're just like, yep, screwed up, here's what we're going to do about it, write you a check, whatever. I mean, and that's our philosophy, is if we make a mistake in your account, I mean, we're human beings, you know, so I don't know if any, you know, I know that there's at least one person in the room where we made a mistake in the person's account, and, you know, we wrote her a check, or we made it up just immediately, and that's sort of our philosophy, is we make a mistake, we admit it quick, and we move heaven and earth to fix it, and that's what the Forum guys have done. So I think that speaks volumes for the kind of people that they are. So. All right, I just wanted to wrap it up with a couple of closing comments back to this slide, and I wanted to make a point with this slide of, we have done our darndest to sit with you and invest time and listen to what you're really trying to do, and to measure your risk tolerance, and to understand what kind of a portfolio that, you know, you can hold without undue risk or undue worry, I guess is really what I'm trying to say. And it seems to me that maybe this discussion is a little bit like preaching to the choir, because you guys are just the greatest people to work for. Maybe I'm all worked up about it and you're not. But the point I wanted to make is, you know, this was all fine when we get, you know, excited about making more money and making more money. And this is kind of, I want to use a different example with this. You know, everyone was happy in 2017. And then I think everybody in the room said, yeah, we got a little nervous this week. I mean, come on, you guys, you aren't human unless you got a little nervous this week. All right? But what I wanted to say is that this down here, the area where we panic and we sell, this is the no-go zone, okay? This is out of bounds. If you're getting anywhere near the no-go zone where you're going to push the panic button and eject, especially if things get like 2 or 3 or 4 times worse than they are today, which they very well can. They have and they will. I mean, I'm just trying to say we are here to help. I mean, I don't know if anyone is in the room is there. This whole thing, you know, because we haven't had a correction in about 2 years. And I think it probably made some people. But if you ever get there, please know. I mean, that's our job. We're there to help. Give us a call. Get into our office. We will. We won't try to talk you into or out of everything, but we may do some of this educational stuff. But take a look at your portfolio, and you know, in relation to your cash flow needs and your cash flow goals. And Dennis and I will map out. Well, here's your short-term money and your medium-term money and your long-term money, so you can see what's going. And then you still may say, well, I don't care about all that academic crap and all that. I mean, I don't care what that computer module says. I am not going to sit here and watch my portfolio go down like it did in 2008. I'm too old, and I can't. It'll give me a damn heart attack. I'm not. If you're getting close to that, all I'm saying is we're here to help. Don't hesitate to call on us. Our sole purpose is to help you make the most of your one financial life, however that looks. So. Anyway, I just wanted to kind of get that off my chest, and it's, you know, because I know some people are probably. I'm going to wrap it up. Thank you so much for being here. I hope you found it helpful. We're always here to help. So.